everyone, thank you very much for joining us here live on Zoom. And if you're listening to the recording, good to have you as well. This is I really want to say our flagship webinar or our flagship content. This is everyone's favorite. This is our trade tracker or our deal flow analysis webinars we host quarterly. We're presenting today our deal flow from the previous quarter and then deriving insights from that data and comparing it to previous data, as well as comparing the data across different markets. So just as a refresher for everybody that may be joining us for the first time for one of these, the spreadsheet that you see in front of you, no, we will not share it, but we can share a blank one if you want to do this for your own market, if you want to do it for your own deal flow. But the spreadsheet in front of you is what we call our trade tracker, and it is a basically a database of all the deals we underwrote for the previous quarter. And it's not necessarily all the deals. Some deals we just choose not to include, maybe because we didn't do a full underwriting or we didn't take the deal very seriously, or it just got killed basically too early in our process to really track fully. And maybe Charles can later touch on kind of how baked the deal needs to get in order to really have all this data. But essentially, each row that you see is a deal, and you can see kind of the first column being market. So you can see what market the deal is in, whether it was marketed or off market, number of units, year it was built, and so on. And each deal, like I said, in order to make it into the spreadsheet, needs to be fully underwritten. So we have an underwriting model, which is a whole separate spreadsheet for each one of these deals that you see here. And that's how we derive the cap rates for each deal here in the rows, the yield on cost, the CapEx budgets, et cetera, right? So yeah, without further ado, I'll turn it over to Charles just to further set the stage and kind of give a highlight overview of what this quarter looked like.
Well, sure. Yeah. So I guess we're not going to go over any of the specific areas. Well,
yeah, might as well introduce it.
Well, I guess just kind of what's broadly happened, right? I mean, obviously since, March, things have kind of been, we've just been in this rate hiking cycle and the market's kind of just been softening since then. So there was a big move in, Q1, at the end of Q1, the beginning of Q2, and then, but it's continued to soften through, this most recent period quite a lot as well. So even though there was a big hit initially, there's absolutely ongoing softening now. But yeah, so as far as, this tracker sheet, obviously we're just, market, was it off market or on market? This in this environment, we're seeing more off market deals. We go into that more later. Unit count, and so also in the sheet, off-market deals, of course, just to protect our, our sources, kind of a little bit, anonymized. They're rounded to the nearest 50, in the nearest 5 years, and the specific size-related information is kind of mostly blocked out. And then, yeah, so generally what's going on here, though, is a comparison between kind of the state of the market, right? Like the asking price. So for example, here, the guide price, guide dollars per unit versus our bid. And then how the metrics look at that as well. So, dollars a foot at us, dollars a foot that we would pay, cap rate, in the market, what they want, cap rate that we can make sense of.
Hey, let me jump in and explain this, this big cap rate. If you could see the cap rates header that covers this big area that's kind of various shades of green. So you can see that the sub header is asking. And so that's the price that the seller wants, or that the broker is going out to the market. And that's the whisper price or the strike price for the deal. Of course, strike prices are subject to change, right? A broker and a seller might come out to the market at a certain price, and then after getting some feedback, they may revise the price lower and go back out to the market, which I'm sure we're all experiencing that now, where deals are kind of dragging on longer, and the longer they drag on, the lower the asking price goes on. So there's a bit fuzziness in that data in terms of that moving target of asking price. And then the other column or header, subheader to the right is LSC, which is basically our price that we would pay, the LSC price. What would we pay for this deal? And then there's translating cap rates, yield on cost, the spread between the underwritten cap rate and the yield on cost, as well as a development spread, which is new. So I'm not sure how many people were on the previous webinar in Q2, but we had a discussion on there, and some people were asking thoughtful questions in the chat about development spread, and we basically figured, well, why not we just add development spread to this trade tracker. So for those that aren't familiar, development spread is the difference between your yield on cost and the exit cap rate. So, and the reason for that is kind of indicates how much value you're creating through your business plan. For example, if you're able to buy a deal at a 5 cap, and then through your value add plan, push that yield on cost to a 7 cap, or a 7% yield on cost, and then the market cap rate is, let's say, 5.5. Well, now you've created a 1.5% development spread between your yield on cost and the exit cap rate. And that when you sell and sell it at that 5.5 cap, you're able to capture all that value. And that's basically your upside. So the development spread is very important. And I think we'll be talking about some pretty interesting nuances about the development spread, because it has gone up a lot. I mean, because financing was so accretive 6 months ago, when debt was really cheap and lenders were willing to provide a lot of cheap, high leverage, the development spread didn't need to be very big in order for the numbers to make sense. You got so much of the return attribution from debt that you didn't really need much of a spread there. And so now we're seeing a reverse of that trend, as debt has become far less accretive. Now development spreads are becoming much more healthy and larger in order to make deals work. So not only are cap rates pushing up, development spreads are pushing up, which means yield on costs are going up.
Okay, yeah. So I mean, obviously we've got these, kind of layouts of the market cap rates, and then I guess we can just keep going right. And then so after the cap rates, you get the result of this development spread, the return metrics, which in the market, of course, tend to not be tremendous. And then what we would like to see, what makes sense for us given the risk profile and sort of specifics of each deal, where we would bid. And then we have hit rate, so this is like how transactable we are in a given deal, are we able to, get close to guidance price, or are we really far apart? And in the market, of course, that's also widened. And then operations, these are mainly used just for calculating the other ones. Really, these feed into the cap rates, of course, because the NOI over the purchase price or capitalization gives you the cap rate, and then the CapEx built in for the yield on cost. So that's kind of what those columns do, but it is informative also just to see, CapEx budgets, which indicate kind of the level of involvement maybe in the deal.
Yeah, and let's just touch on the hit rate. I think that's a pretty easy thing to check in on, and a nuance. You want me to hit escape?
Yeah, can you? Yeah. Oh,
So
maybe not. Okay.
So this hit rate, if you can just scroll a little bit.
Okay.
Yep. So this hit rate is right here. And as Charles mentioned, it shows the difference between the strike price and our price. And so that gap has continued to widen for the last 2 quarters, where I think it peaked in maybe Q1, right? Debt was really cheap, and it was not that difficult to make sense of deals. I think on average, our underwriting was 8% less than the market price, or the price that people were going to strike at. Now, deals were trading above strike a lot, right? Brokers would go out to the market and say, hey, we want to sell this deal for 50 million, and then bids would come in, and then the deal would trade above that. So that's certainly possible. But by and large, our bid to ask spread for us was only about 10%, which I think is pretty healthy. And shows that even though the market was really hot, we were still pretty conservative. And at the end of the day, we weren't buying every deal. But now you can see the average bid to ask spread for us. Do we have that average at the bottom?
Yeah, so we were at 92 in Q1, and then we moved to 87, and now we're at 80. So it's, continued to widen significantly. You can see that here.
So you can see basically deals are getting tougher to do. And this isn't necessarily anything to do with us, it's just the market. So if you think about, let's say, I mean, I don't want to say Q1 was necessarily an example of a healthy market or a normal market, but if we have, generally speaking, maybe a 10% bid-ask spread, that's just us being, we're looking for a little bit of alpha. We're not just going to buy every deal. We're looking for the best deals. That's causes a 10% bid-to-ask spread on average. But now we're down to 80%. And I think that 10% difference going from 90 to 80 is the market dislocation that we're experiencing right now. It doesn't necessarily mean that we've gotten way more conservative and we're backing down our price. I think our buy is still around 10%, but the reason why we're now 20% off is because that 10% of bid to ask spread that's baked into the market, that's market wide bid to ask spread. Because I think generally speaking, the average buyer is now probably 90% of their price, trying 90% of what sellers want. So because we have that gap there where sellers want 100 million and buyers only willing to pay 90 million, we're seeing transaction activity really slow down. So what is your take anecdotally as well as in the data as far as transaction activity for this quarter as compared to the previous couple?
Well, yeah, I mean, I guess, well, so I'm from the data first, the bid-ask spread, right? So where does that come from? On the one hand, what we're able to pay, due to the debt and the return metrics we need to meet, our bids per door or, so have come down 13%, I guess. So the price that we're willing to pay has come down 13% in the bids, and this is a little bit of a skewed bit of information here, but and then the price of the actual deals that we're looking at in us is going to come down 4%, and then same thing with asking cap rates versus what we're underwriting to, and with yield on cost as well, right? So at the market asking price, they were at 3.2 cap Q1, 3.2 cap last quarter. Now they're at 3.5 cap. We make it this. I mean, I think they're kind of wider now and they were narrower at the beginning of the quarter. But nonetheless, that's only come out a little bit relatively, whereas what we need has come out a lot, right? I mean, our yield on cost has gone from 5.7 to 6.1 to 6.8. So we've come up over a point in what we need, which is, so there's just a big difference there. And so obviously on the one hand, what we need has gone up a lot due to the debt being more expensive, but what is available has only, the pricing has not softened all the way. So, and you can also see it, I mean, there's been all, because of the failed, so what happened, right, essentially is that a lot of people stuck to their prices, and consequently they still have their assets and they haven't moved, they haven't sold. And then if they're not necessarily set on selling, or they don't want to overexpose or whatever, or they already failed or didn't accept a bid at the end of their marketing process. So a lot of the stuff that we've been looking at is just stuff from last quarter, honestly, that's been, on the shelf, or maybe they come out again, they reduce their price a bit, maybe not as much as we need. And so that's one thing that we can see here in the market to off market ratio. So, last quarter we saw 47% marketed and 53% off market, and this quarter really up to 2/3 off market and 1/3 marketed that we really dug into. Because just so much of what's happening, the marketed deals really slowed down because people don't feel it's a great environment to launch. A lot of the stuff has already been launched and just not gone that well. And then as far as how the processes are running, right, earlier in the year, right, you couldn't preempt the deal, right? They wanted to get a bidding war going because, the price just kept going up. Now, the longer you sit on the shelf, the price keeps going down. So no one's so married to the process, but at the same time, they still want yesterday's price. So if you, you can theoretically preempt many more deals today than you could in the past, as long as you hit the number. But in practice, if there's going to be price discovery, then you're going to wait for the process to run out, because it's only when they see a pile of bad bids that they might consider taking one. So
Yeah, this is the difficulty, but the opportunity of private markets, because when economic data and bad news come out, the stock market adjusts immediately. When the 10-year moves, the stock market adjusts immediately. But private markets take a lot longer, and that's due to the frictional sales process and the psychology and emotions of sellers. Like Charles is describing, a seller isn't going to just look at the 10-year and look at where debt is at today and go, okay, well, my $50 million property is now with 40. No problem, I'll sell it for 40. It's a path of attrition where they wanted to sell for 50 and they were getting bids for 52, and they got 20 of them, and they laughed at them and said, no, I actually want 55. And then they missed their window of opportunity to sell, and now all those bids are gone. The new bids are coming in kind of in the low 40s, and they're not mentally ready to transact at that level. So they kind of sit, and then maybe they say, okay, well, actually we're ready at 48, still nothing and still nothing. So it takes months and months and months. So I think, as Charles pointed out, our underwriting, which is just us plugging numbers into a spreadsheet, can dynamically adjust right away. So you're seeing quarter over quarter, our changes in our underwritten cap rate for the price that we would be willing to pay has gone up and up and up. And same with our yield on cost. And however, the asking prices are much slower to move. They've only gone up 30 bips, which is totally insufficient. So that, again, just speaks to the bid to ask gap that we're experiencing, which makes transacting really difficult. And, you know, I think that is a market-wide issue that will resolve itself over time as sellers come down and maybe debt improves so that buyers are able to come up and maybe meet somewhere in the middle. So do you want to talk about Houston versus DFW next, and kind of talk about how DFW was hit a bit harder, seemingly?
Sure. Yeah. I mean, I think as far as the numbers are concerned, you know, we don't even have that big a Dallas data set, but, you know, yeah, obviously, you know, Dallas, you know, reached like a 2 handle over this year on average, which is just really tough to figure. And you know, because it was so hot, you know, there was it then when the money kind of went away a little bit and the temperature cooled a little bit, then all of a sudden they are the ones who really, you know, Houston has always been, some people just don't like it, whereas everyone likes Dallas. And so when it was go-go there, you know, it was very go-go, and now it's really backed off quite a bit. There is definitely stuff coming to market now at this point again, but it's definitely not the pace it was. Yeah, I mean, I think the thing with Dallas and also Houston to some extent is though that on the one hand, there's kind of, oh, the rates have risen, you know, valuations have to come down because of discount rates and things like this, you know, spreads. But on the other hand, there's also things like, you know, inflation, do they need to sell? Rent growth is going to bail them out, which is happening in a lot of places, unless they bought very recently. So there's just a number of things where people are able to credibly just sit there and, you know, they might hope either that rent will keep growing, which, you know, maybe nationally rent is not growing, but in Texas it is. And then also, not everyone, I guess, believes that the Fed is going to keep doing this, which of course, if you are of that view, then of course you're not going to sell now either.
Yeah, and I think seemingly the lower cap rates are, which DFW has lower cap rates than Houston, you're more interest rate sensitive. So then once rates started moving up, that impacted DFW more than Houston, because it's not like just because DFW is just by the numbers, just if you follow the money and believe in all the institutional investors that are moving their weight around, you have to believe that DFW is a better market than Houston just by the numbers, because investors are willing to pay a lower cap rate. That means they think that there's more safety, that means there's more growth. So equity thinks that DFW is a better market, but that doesn't mean the debt is priced super discriminately between the two markets. There is a difference, and it depends on the product, but I would say that the difference in cap rate is less than the difference in interest rate. So when interest rates go up, and they're kind of going up at the same rate, and if you're borrowing at the same rates in both markets, then you're going to be hit harder where the cap rates were lower because they're just going to have to move up higher. So I think we're seeing that, but that doesn't mean that DFW is all of a sudden on sale right now. It's still what, a 3.4 cap right now?
Yeah, and of course, it's 3.4 cap today is, not easy to transact at. You just need to find the value add, and it's always tough. But I think probably, it's a bit of a transitional period, right? It will either become clear that pricing is just going to continue staying, and if inflation continues and or rates have to come down again, then presumably if that just is fulfilled, then you get back to kind of go-go days. But if not, then eventually it becomes clear that doesn't happen. Probably also we see stuff trading as well. It's just this transitional phase where it's not quite clear yet which one's going to be.
You want to go over to the IRRs, unlevered and project? So, I mean, it seems like this just has to be the case, but unlevered IRRs are going up. As I said before, if debt is making less of a positive impact on your deal, then you need more unlevered return to get to the same projected levered return that you want, right? So hopefully that makes sense, and feel free to put in the comments if you want us to further clarify that. But that brings up a good assumption, and that assumption is, should we still be solving for the same levered returns, or should that dynamically change also in this environment? Equity investors seemingly are always basically looking for a 15% net IRR, right? And it doesn't really change whether rates are up or down. I mean, I've talked to a handful of institutional investors that have an explicit bogey like that based on their fund, and that isn't changing. So it's kind of interesting to see that when interest rates change, lenders' terms change, their interest rates change, but equity seems to kind of stay the same and absorb the residual return there, or at least target to. So are we changing seemingly the IRRs that we're seeking, and then how does that correlate to the unlevered?
Yeah, I mean, I think we're kind of just solving for the same thing, which is what you just said pretty much. How does it correlate the unlevered? But you need a higher unlevered to reach the same levered now because the debt is more expensive. So yeah, I mean, but it is the case. There is kind of this story out there, of course, that with rates being higher, there are going to be alternatives now to just being in very risky assets, but there isn't really anything else out there. There are a few other things that achieve these kinds of absolute returns, and so maybe there are alternatives, but I think this is probably we're going to be solving for these numbers for a while, and I think they're probably going to stay there.
So another interesting thing, which is new for the trade tracker, is the underwritten exit cap rate. So you can see that column V, exit cap rate, underwritten exit. So that is the exit cap rate that we're projecting for all of these deals across mostly Houston and DFW. So you can see the average for this past quarter was 5.43. So a lot of people have been asking us, where are your exit cap rates now? That's definitely a very hot topic. And so, that's exactly where they are. So I'd say they're kind of somewhere between 5.25 and 5.75, which is roughly, I would say, 50 bips, maybe 50 to 75 bips wider than where they were. I would say kind of the lowest exit cap rates we were going with were around 4.5. And then on the high end, we would maybe be at 5.25. So everything's shifted up to reflect today's environment.
Yeah, I mean, so probably Q1 we'd be in like a kind of 4.5 to 5 range, and then with the big moves, we basically went up 50 bips to 5 to 5.5, and then now probably another 25 bips of creep. So now 5.25 to 5.75.
Would you see, and obviously a lot of this talk is about the market, but one thing to mention is we're not trying to time the market or predict the market. We take it as it comes, and we're just trying to make investment decisions daily. So we're not taking all this data to try to say, well, we think prices are going to go up or down in the future. We're just sticking to our conservative underwriting fundamentals. But with that being said, do you think that we could see our exit cap rates continue to move up, or do you think that we're kind of factoring in maybe the worst of it and that things maybe should improve? What do you think?
I mean, my thoughts are kind of just, it all depends on the market and rates, which is, we all know. But it's not a guarantee that just because rates keep going up, cap rates are going to go out the same amount, right? I mean, there's just demand to buy real estate, and maybe the spread just kind of absorbs a lot of it, or the risk premium is reduced. It's not necessarily the case that it's going to just always widen, but certainly, I mean, you could see it getting wider. I mean, if rates go up another, however much, it's definitely going to keep getting wider, but maybe not at the same rate as the rates get wider.
Cool. So somewhat of a related discussion is a question from Alex about rent growth that we were underwriting earlier in the year versus what we are underwriting now, and why that might have changed.
I mean, I think mostly we're underwriting the same rent growth, except that on the baseline, we were never really the most aggressive. We were at 3-on-2 in Houston and 4-on-3 in Dallas, which, is market-ish. And then where extra rent growth might come in from the economy would be in, like, we would also then include kind of some estimate of, projected rents in the market, which could be well above that. From Yardi or CoStar, whoever, everyone's seen these forecasts about, rent is going to go up 10%, this year or whatever, or 5% or something, elevated 4% per year through, 2025 or something. And maybe some of those have softened a bit, but my perception also is that rent is growing in Texas. Texas is a migration market, there's only so much housing there. And, so while rent growth is softening in some places, it's not just kind of a universal story that rents are softening.
Yeah, so we're never ones to fully bake in the rent growth that is potentially out there in the market being observed or projected. We stay pretty consistent with our, like Charles said, 3% rent growth over 2% expense growth. And obviously both of those numbers have been wrong recently to the upside. And the important thing to point out there is when your rent growth is up and your expense growth is up, even if they're the same, you're still winning, you're still doing better. So like if you're growing rents at 3%, but growing expenses at 2%, you actually would have a higher IRR projection if you grew rents at 5% and expenses at 5%. So inflation really does benefit real estate in a vacuum. Obviously, there's a bunch of other things that inflation does to real estate that could be bad, but as far as growth, it usually is good for your NOI. So with that being said, the way that rent growth would affect the underwriting is kind of the cap rate that we're willing to pay, because we're not necessarily willing to change our underwriting. We're not going to want to get more aggressive and say, yeah, well, let's just project 4, 5, 6% rent growth. Instead, we might say, yeah, we'll squeeze a little bit and pay a little more for this deal because we think we'll outperform what we're projecting on the rent growth. So we'll have a deal that maybe is a 15% IRR instead of a 16% IRR because we feel like there's a lot of strength in that market and opportunity that isn't fully baked in to the numbers. So that's kind of where the wiggle room is changing in return hurdles or the return requirement that we want to see from the deal, rather than changing up all of our assumptions, such as the rent growth. Okay, so what next do we have here?
Can we, like, this records this, right? Like, it doesn't record this, does it?
This is recording the entire screen.
Oh, okay. Was recording me though, right? So
yeah.
yeah. So Yeah, what else do we have? Yeah, I mean, CapEx, for example, like speaking of inflation, I mean, that's one area here. Our CapEx budgets have crept up. So, last quarter we were at 10,049. Now we're 10,575. I mean, that is, 5%, 6% growth, which is, significant.
Yeah, and I don't think it's all due to inflation, right? It is in part also due to the fact that we're looking at deals with more value add, right?
Yeah.
Yeah, but that is interesting, and that definitely is causing something there. We have a good question about rent growth and exit cap rate assumptions changing based on the submarkets that we're looking in. So, as far as rent growth, we don't really change rent growth too much based on the submarket that we're in.
I mean, I think we can be more confident about the future performance to some extent if we're in a strong submarket, but I mean, we're not going to change the kind of perpetuity trend at all for sure.
But the exit cap rate, absolutely, we are pretty hyper specific with the exit cap rate. It's not just, oh, Houston is this exit cap rate and DFW is this exit cap rate. We're looking very much at all the nuances of the deal as far as its vintage, size, location, business plan, growth prospects.
Yeah, I mean, there's also just kind of the aspect of if it's an area we don't like, we just, the cap rate's a bit moot, we're not going to bid. So, but yeah, I mean, obviously, if we really like the area and we feel it has strong prospects and is relatively, it's going to always be desirable, then we probably are willing to have a slightly tighter exit cap. And likewise, if it's really a sort of a bulk standard baseline area, it'll be a little bit wider, and same thing with product as well.
Okay, cool. Well, I think we can open it up to questions. At this point, you can continue to put your questions in the chat, or you can unmute yourself and you can just ask it live. Let's see. Well, while we're waiting for a question, we can go down to the percentiles tables, which we haven't covered yet. So the percentiles here, the bid to ask is, well, first, the top two tables are Q3 and the bottom are Q2. So just focusing on Q3, what we already talked about is this 82% bid to ask spread at the 50th percentile. So that means the 50th percentile deal has a bid to ask gap of 18%. And if you buy the 50th percentile deal at the ask price, it's a 9% project IRR, right? We're using project, right?
Yeah.
Yeah. So 9% project IRR, then you add fees to that and you add promote to that, very little promote, you're going to end up with around maybe like a 6 or maybe a 7% IRR. So that's kind of the average deal that you're looking at. That's at the 50th percentile. If you look at the mean, it's cut in half. I mean, the mean deal is, very bad, almost break even. So it really requires the top percentile of deals to really find something attractive today, which is, it's always hard to find deals, but it definitely is a bit harder right now.
Well, one thing that is interesting about these percentiles is if you look at last quarter, our 95th percentile was 100%. So we were actually basically at the guidance, even the top 10% of deals. Now we're not really getting there in anything. The only caveat to that, right, of course, is also that previously getting to the ask price might not win you the deal because it might go for higher, and now getting below the ask price, you still might win the deal. In fact, you're quite likely to. So,
definitely. Yeah, it's a really good point. Really good point. So yeah, so these tables are interesting to see kind of for the top tier deals. And just because a deal has an IRR that's in the top, 1 percentile doesn't mean it is actually a good deal in a weird way, because it could have a high IRR, but it could also be a very risky deal. So obviously we're not adjusting for risk here. So it doesn't mean it's the best deal of the pile because it has the highest IRR. So that's something that we, of course, take very seriously and analyze on a deal by deal basis. We can definitely go back to these percentile tables, but just to answer a quick question coming in the chat, someone is asking, do we JV any of our deals, or are they all syndications? So just to talk about, actual execution on all this stuff, we are a vertically integrated owner operator. We're here based in New York, and we have our management team based in Houston. Almost all of our portfolio is based in Houston currently. We are looking to, as you can see, looking to break into DFW, and would like to make a big splash and build a big portfolio in DFW, just as we have done successfully in Houston. And to capitalize all of our deals, we, on the equity side at least, we have done a blend of joint ventures with family offices and private equity firms. We've also done syndications where we brought in high net worth individuals and fund of funds and co-GP partners. So we have a very diverse group of investors, and every deal is different. So we like to keep that flexibility open. So hopefully that answers your question. And if anyone's interested in learning more about partnering with us, just feel free to reach out to me, and we can discuss more. Another question is, what do you guys recommend we do to find and consistently close deals in this current market? So I think really the best thing you can do is to find a debt strategy that works for you, because the hardest way to make sense of deals today is the debt. And so that's actually something we didn't really touch on yet, which is kind of the debt strategy. So from the previous quarter, our pivot in the face of all these changes, our pivot was to go to lower leverage bank debt. And that's a conservative strategy. And it made it so that we could actually bring our interest rate down as much as possible, because the steepness, if you will, of the leverage versus interest rate curve got really steep. It was very flat before, meaning that whether you were borrowing at 60% leverage or 80% leverage, the interest rate was not very different. But now the difference in interest rate between borrowing at 60% and 80%, it's, it could be 150, 200 basis point difference. And that is going to completely put your deal upside down. So by borrowing lower leverage, we're being more conservative, and we're getting the lowest interest rates. We're able to maximize cash flow. So that was working in Q2. But now for Q3, the banks have really kind of put a pause on what they're doing, because they became the hot commodity in Q2, put out a lot of loans, and now they're kind of cooling off and not trying to do as much business. So
I mean, they're under pressure, of course, to, be capitalized and stuff and not just go crazy. But yeah,
so if banks aren't really an option or a readily available option, then what's next, right? You look at agency and kind of what's happening with agency right now.
Well, yes, I mean, agency, is continuing to go up in line with all the other interest rates, right? So I think I just heard that currently we're around low sixes for agency fixed. So, that's definitely a far cry from where it was, 2 weeks ago, but, so only a few months ago. And, when you start looking at interest rates like that, of course, then you really start to question about cap rates and yields and everything. I mean, you just can't, the numbers don't really make that much sense if you're just always having this negative spread between your debt and your cap rates, and quite negative as well. But yeah, so I mean, with the banks kind of leaving, we're really looking at, maybe agency plus pref. There are some other options out there as well, like life cos or whatever. I guess there's also debt funds, but they're very expensive. So yeah, I mean, and the thing is also is that you can, and with agency float, then it's really tough going in. And with the
Do you want to explain? I mean, we don't have to turn this into a financing discussion, but
yeah.
Do you want to explain the difference between going, the floating and why it's difficult to go in versus fixed? And, do you want to explain all that?
Well, yeah, I mean, with the fixed, they're pricing based off the bonds, and, it's going to be a longer term, and the yields are, you're stuck with it for the long term. So you don't get the benefit if the rate comes down, at least necessarily, unless you pay more on the rate going in. The flip side of that is that, you pay that lower rate going in than you would today, right? Today with a float is probably, mid sixes, almost 7, I think. Now you go in what, 290 plus.
Yeah, I mean, it depends what you're borrowing and all that, but to keep it simple, the forward curve is projecting that SOFR continues to rise, then it will go down. So in the short to medium term, really short term, your rate is going to be high, your pay rate is going to be high. And then as SOFR comes down, projected at least, then you're going to start benefiting from the floating rate going down. But the issue is also compounded by the fact that you need to buy a rate cap.
Oh yeah. Okay.
And yeah, so paying the really heavy price of a rate cap going in is something that you have to fully factor in and consider. I mean, we're closing on a deal in a month or so that has it's a floater, but we are buying a good rate cap. It's something that you have to really factor in. So it's not doable, but you have to make it work. And then on the fixed rate side, Charles explained well that, sure, you can lock in a fixed rate, but what you're locking in is kind of the worst terms in a while. It doesn't mean terms aren't going to get worse, but it's not, they're probably going to get better. So you're locking in a higher interest rate, most likely, and not the best terms as far as leverage due to DSCR constraints. So that's the trouble with going fixed, is you're kind of locking yourself into this situation and it's expensive to get out of it. So really, there's no perfect scenario. Unfortunately, there's no perfect product out there. But I think to answer your question after a really long time, it is finding the best debt product for you and your strategy. I think that's how you can actually find and consistently close deals. If you can find a product that actually works, then you can really make something happen. And so we had some good stuff going, and we've closed a few deals this year in the turmoil, but now it's continuing to get harder.
Yeah, and of course, I mean, the debt space was very crowded, like every debt fund was, here, like, 2 quarters ago, and now they're all not really useful anymore, right? So, and there's been a lot of retrades from the debt, in general. And so certainty matters in a way now that it didn't before. And so that is like to that kind of finding the right debt. It's not just numbers, it's also, are they actually going to live up to them?
Big time.
Mm-hmm.
So another question coming in the chat is about sensitivity analysis and how we incorporate in our acquisition process. Do we look at distribution metrics or distribution of metrics like exit cap and IRR? So those sensitivity tables are that you're referring to, where you sensitize exit cap and rent growth and you show the different IRRs. I mean, in my opinion, I think that's really more for investors. Investors like to see those things, and then they are comforted by the dispersion of outcomes. I think when it comes to actually our acquisitions process, we don't really spend much time focusing on that. Is that correct?
Sure. I mean, well, the thing is that relatively, you just know how it's going to go, right? I mean, if you're levering up the deal, you're going to have higher IRR and worse, polarized outcomes, but also more upside, right? If you have low cap rate going in with big development spread, and big yield on cost, you're going to have high IRR and low cash flow, and those, right? So like, they're just a few general things that are going to affect those sensitivities specifically, right? So more debt is going to make it more extreme, tighter going in cap rate is going to make it more extreme. If you buy it with a going in cap rate that's, healthy going in cap rate, it's going to have a better downside scenario and less exciting upside, probably. I mean, unless it's just the most amazing deal on the planet. But either way, like, because it had a going in cap rate, you're just not going to have the same downside that you would on some of the other deals. Yeah, so I mean, I think there are other, if you understand what drives the sensitivity table, then we're always thinking about those things.
Yeah, and without actually explicitly looking at that table, we are plugging in different numbers for the exit cap and just kind of sensitizing the deal and looking at, okay, what price can we afford to pay, and what assumptions do we have to make to be able to pay the price that will get the deal done. So it's always a give and take across the different assumptions and what we're comfortable with. So another actually good question here from Alex is about LOIs. So are all of these deals that we're looking at, which, how many deals do we have in the tracker this quarter?
67.
67. So it's a lighter quarter, right? There's less transaction activity. So are we submitting formal LOIs on all of these deals, or are we just providing verbal feedback, or what does our LOI process look like?
Yeah, I mean, we're definitely not submitting formal LOIs on all these deals because most of them were not really even in striking distance. Which then we are providing quite a bit of verbal feedback. And these days there is kind of more, you have to be confident in your feedback because it's quite likely you'll get called on it, especially in a market like this. You just don't know what's going to happen. So, certainly you can't expect that you're just going to be able to come in with a low ball, it's going to work, but it does happen. So, it's just kind of, you want to be feeding back as much as possible. And then I like to just talk to them and see if, if they want an LOI kind of, I mean, if it's going to help shake it loose, we'll definitely do it. And, of course we participate in processes and, do kind of just send them out, but if we really like the deal, but at the same time, it's not worth submitting an LOI if the deal is just not going to work.
Hey guys,
Cool.
my name is Moses.
Last questions? Sorry,
Hey,
I think we have you muted. Here, sorry. You're muted down here, right?
With me, I'm muted, yeah.
Okay. Here, Moise, go ahead.
Can you guys hear me?
Oh, geez. All right, hold on. Give us a sec.
I can put his.
No, this is my fault. All right, go for it. One more time. Sorry about that.
Can you guys hear me?
Yes.
Cool. First of all, thank you guys for putting this together. This is awesome. My name is Moses Correa. I'm an investor here in Chicago. I had a quick question about holding periods. So obviously that has a big impact on the returns that you go out to investors with. How do you guys think about that? How do you kind of think through like a 3-year versus a 5-year? Is there something in the market that's guiding that decision, or what's kind of driving that?
Yeah. Well, the decision that's driving that is really simple. It's just the debt.
Gotcha.
So if we are doing financing that's more long-term and has an owner's prepayment penalty for exiting early, then it's just going to make more sense to underwrite a 5-year hold. If it's more of like a bank loan or bridge loan where we have flexibility to exit early and it's a value add plan where really the value of the deal is through the buy and sell of it, then it would be a 3-year deal to match, either to match the term of the debt or to the business plan. And it's a very good question that you're asking, and it certainly does have a big impact on the return, right? You take the same exact deal and you just change the hold period from 3 to 5 years, you're going to have a different return. Right. So, and also another interesting way to look at it is the confidence with which you're making certain assumptions can go up or down based on hold period. If you're underwriting a 3-year hold, well, then 3% rent growth per year, that's not as a crazy bet to make, because we probably will have something roughly like 3% per year for the next 3 years. But over 5 years, over 10 years, it becomes a much bigger assumption, and the compounding nature of the numbers make it so that if you're wrong, it's even more impactful to the deal. So, any other thoughts about 3 versus 5?
I mean, the market's fairly efficient in my view. There's nothing, usually it's rare to find extreme inefficiency. And so, if it has substantial upside through doing something, then it's going to be asking significantly more than it's worth based on going in cash flow, whatever. So you're going to have a tight cap rate. You're not going to be able to finance it with permanent debt, or, you're going to hit your return metrics, you're going to be doing an IRR play, right? On the other hand, if it's to really be able to achieve good returns through a 5-year hold via cash flow, and you're going to have, like, to support the permanent debt and to have this return profile, it's going to probably have less upside, and then it's going to have a 5-year hold. Like, if it's a lift play, then you're going to be on 3-year, and it's not going to size properly for permanent debt the same way. And if it's a yield play, then it's going to have a different profile.
Got it. That's super helpful. Thank you, guys.
Yeah, no problem. All right, well, we have time for one more question if anybody has one, again, in the chat, or if you want to unmute yourself. If not, we're going to wrap it up, and this is recorded, so we'll be sending out the recording and the blank template out as well. So be on the lookout for that. And then also next month, we'll be having our quarterly portfolio analysis webinar, where our asset manager, Josh, and myself go over the happenings in our portfolio and the insights that we're seeing in our portfolio rather than our acquisitions pipeline. If you want to connect with us, just feel free to email me directly, rob@lscre.com. Yeah, like I said, you'll be getting an email from us, so you can follow up with me on that as well. Okay, cool. We're going to wrap it up. Thanks everyone for joining us and sticking around. We'll definitely look forward to seeing you guys next time.